Let's tackle a very important story. And the big one is that the rupee has plummeted to fresh lows, inching towards that 80 rupees against the dollar. So one would imagine that this would be a bumper time for exporters. And India is big on textile exports. Last year, we exported close to $16 billion, and it was projected that this year, the textile exports would surge to more than $20 billion. Also, cotton prices have seen a decline in the recent few weeks. So all this spells good news for textile majors. But unfortunately, they are facing a bit of a pushback from global apparel majors who are demanding some discount. They are demanding that perhaps the Indian textile exporters share some of the benefits that they are seeing. To discuss all this and much more, we are joined by Mr. Narendra Goenka, the chairman of the Apparel Export Promotion Council, AEPC, on the show now. Mr. Goenka, morning, and thanks so much for joining in. First up, if you could just lay out the context for us, what is happening on the ground in terms of the Indian textile majors, the benefits that you've seen because of rupee depreciation and the lower cotton prices, and what is it that your negotiations with the global brands are telling us?
Yeah, good morning again. I must correct you, was 16 billion was only apparel exports, not the complete textile. Complete textile, we had $44 billion exports last year. This year, apparel exports, we have a target of good $19 to $20 billion. But there are some headwinds in terms of the real recession in our traditional markets, namely US and Europe. But simultaneously, we have little relief on the cotton and raw material prices, yarn prices. But that relief is little minuscule because we had prices had gone up about 150%, and now they are down by 15%. And whereas in USA and China, cotton prices have come down heavily, still Indian cotton is 50 to 60 cents expensive than US and China. So the customers started asking us to reduce our prices to factor in the reduction in the raw material prices, 1 point. Secondly, they want a little reduction on the account of little expensive strong dollar, which is like has gone up approximately 5 to 6% in last 3 months time. So customers requesting for better prices to the tune of 10 to 15%, and almost they are looking pre-COVID prices. So in one side, we have a little benefit of cotton prices and the dollar, but other side, we have to fight with the recession, which is so customers are really feeling pinch of the recession as consumers are buying mostly energy. Their money is going into buying energy and essential. So there are little lesser demand of discretionary buying like apparel and all. So we are facing this kind of little challenges, but we are looking for a little newer markets in Latin America, Australia, Japan, UAE. So we would like to compensate the reduction in demand through the newer markets.
Okay, Mr. Goenka, so we understand your, three-pronged problem. One is the dollar strength, one is that the raw material costs have fallen, and third is that there is a recessionary trend in your target markets right now. But have any contracts been actually cancelled, or are you still looking at negotiating? And is this negotiation to the extent of this 15% fall in cotton prices, or even larger than that?
It's a little larger than that also, because 15% drop in the cotton prices amounts to about 3-4% drop in the final finished goods prices, 3% finished good prices. So, but customers are looking at much larger reduction in the prices to the tune of 10 to 15%. So, and we are little helped by the strong dollar. But that too also it's only to the tune of 4 to 5%. So overall, we are in a little challenging situation. But nevertheless, we have to keep the employment level going on. So we are trying to do best possible and to achieve the target of 19-20 billion dollars.
What could be the extent of a discount or reduced prices that you could give? They're asking for a 10 to 15% reduction. What is it that you are in a position to give?
Below 10%.
That would be 5, 8.
Below 10%, up to 8 to 10%.
8 to 10% you're okay to give.
Yeah, we will have to give it.
Oh. You also said that customers are feeling the pinch of recession. Is that getting reflected in lower volume offtake? Apart from prices, now can you talk about the volumes?
Volume also would be little lower, but we have little opportunity in terms of little challenges in our neighboring countries, Sri Lanka, Pakistan, Myanmar. So there are they are going through a tough time, and Pakistan is going through the tough time for energy. Sri Lanka, everybody knows what is the situation. Myanmar has a little labor issues going on. So there is little opportunity we have. So we definitely try to achieve this, all the challenges we have to capture the market so that we are able to make our targets achieved.
Okay. But for this year, would you be honoring all your export targets, or are you looking at probably scaling that down? And how long will it take for orders from your new geographies to fructify?
New geographies, we expect that spring 23, which is the orders would start coming in sometime in August or September. We hope to have little extra orders from the new geographies for spring 23 and followed by the fall 23 also.
You know, we keep loosely saying that China Plus One is benefiting India, and that is also in the textile industry. Could you just tell us, in terms of production, in terms of exports, what were the numbers from China earlier? What is it right now? How much has India gone up? And you also spoke about Sri Lanka, Myanmar, and Pakistan. So could you just, give us a sense of how much did these countries contribute earlier? And now, because they're facing a challenging time, they are in a difficult position. What is it that their exports are likely to shrink down to?
Definitely, Sri Lanka's export is supposed to go down by definitely 15 to 20%. And we would be able to capture 25% of the reduction they face there. So we will be able to increase our volume by another 3-4% for us. And especially in Pakistan also. Pakistan, we have little competition with apparel, but we have a bigger competition in other textile product from Pakistan. And in China, they were at $180 billion. Which their growth is reducing, and they are not able to maintain that numbers also. So we hope, and every customers of ours is trying to reduce their exposure in China definitely, and which they are looking at India. Definitely they are looking at India, and so we have to keep our house in order by maintaining the raw material prices. Today, I must tell you, the cotton commodity is the biggest employment generation. Because that commodity, if it is going up by 150%, you can understand how big the challenge we will face it in terms of employment also. So we need to control raw material prices of cotton and cotton yarn and all those things. So definitely we need to control going forward raw material exports versus finished goods exports.
And just one final question, Mr. Goenka, since we have you. Could you tell us the big trends that you expect over the next 2 years when it comes to apparel exports?
We definitely need to shift to the man-made fiber product, as internationally the ratio of man-made fiber versus cotton is 70-30. Whereas in India, we have a completely reverse ratio. We are more cotton centric than man-made. So it is in India, it's 60% cotton, 40% man-made fiber. So we need to shift gradually to man-made fiber. So the cotton prices challenges, also cotton shortage also could be addressed.
Thank you, Mr. Goenka, for joining in. That's the word coming in from Apparel Exports Promotion Council, talking about the apparel exports from